Hey, it's Soleil, and this is episode 348 of the Orange Pill Investor. And today I want to answer the question: is there a perfect option? What's up, Howard? Yep, catch you later. Um, the inspiration for this one came from Grains Post and really cool chart here where they superimposed delta and gamma kind of going from a 10% out of the money position and then assuming that the stock will go like 10% in the money. And it's demonstrating how you can capture a ton of gamma, right? Gamma's maxing out when the stock goes through the like the halfway point between hitting at the money and then going 10% out of the money again, and also capturing this rapid expansion in delta, which makes sense because delta is being increased by whatever gamma's value is. So delta is the appreciation of the option based on $1 move, and then the second dollar or the next dollar in that move goes up by delta plus gamma. So totally makes sense. And then my my guy SOS tagged me and correctly said, "Hey, what do you think about this? Because I like to buy the deep out of the money leaps." And then I had my, explanation, just for pure speculation, I can get more delta all the way at the top of the options chain per dollar spent. And I'll show you what I mean about that. But the real question being asked here is who's right and who's wrong. And come on now, like I'm happy just to be picked for the team. Like, am I supposed to go head to head with my boys over here? No, I'm just kidding. It's a fair question. Um, or maybe this is the beginning of the True North Civil War. Will I have to? Will I have to post this? The defense is wrong GIF from my cousin Vinny. You know what I'm saying? Uh, we shall see. So what I meant by my response was, let's just go to July. It's not quite 180 days where I like to start out, but I still have a bunch of Julys. And it's greater than 90 days to expiration, so I would be comfortable holding this for like 70 days, no problem, 67 days. Now the price, I started doing this research, maybe 30 minutes ago, so the price was closer to 330. So these will have slid around a little bit. But let's just say I add $30 to this price, so I go to like 355, 360 for almost 6 grand. One contract, I can get 0.54 delta. Now, if I go all the way to the top of the chart, or actually, what did I say, 5,700? So half of that would be 2,900. So if I spend approximately half that at the 500 strike, is that right? Hold on, let me go back down here, make sure I'm not screwing this up. The 360, okay, so yeah, it's 5,800. Half of that would be 29. So I can get two $2,900 contracts for the same price. And instead of the 0.54 delta, I'm going to get double 0.32 delta. So I'm going to get 0.64 delta for the same price. Now, I wonder, that doesn't look like what my went to oh, good lord. Okay, so that is for July. We go all the way to the 1080s. All right, did I screw something up here? So I went to 360. That this price checks out. That's pretty close to what I went to. And then I went to July 1080s. I was at $31 per option. Oh, you know what? I think I put my purchase price in there. Yeah, so I fucked up my whole research, so that's fun. So in this case, for the same dollar amount, it's approximately 600. I can get 10 of these, the same price. Yeah. Okay. So that just makes it even insanely more. Oh god. All right, but I am gonna have to go through and update my spreadsheet because I bumfuggled the whole second row because I used my cost basis, not the actual price. So I'm gonna have to go through and update this as we go. Tried to do all the research beforehand, but them's the breaks. All right. Is this a fair comparison? One 360 call, it's about 10% out of the money, is going to cost 6 grand. For the same 6 grand, I can get 10 of the 1080s. Same money. And let's just look at how much delta I can get for that. So 0.07 each times 10 is going to be zero point 0.7 delta. So I'm exposing myself to more delta for the same price. Yeah. I'm getting zero point 0.7 delta versus 0.54 delta. All right, so I could just go right to expiration. And so for buying out 10% out of the money would net $155,000 profit if we get just enormous rally, right? To 1980. If we close at expiration at 1980, the 10% out of the money makes $160,000. The 1080s blows that out of water and makes 894,220. So that's I just declare victory, right? I'm right, they're wrong. However, that is just the beginning of the story. And I'm going to go ahead and have to update the spreadsheet as I go along. But rather than go through each individual one, this one should still be correct. But the if we assume that the price is going to go to 440, right? We get a nice like a 20% pump or something, right? The 360 strikes, the ones that are about 10% out of the money, will make a little bit of money. And then if you continue to hold it to expiration, you can turn a $6,000 profit into a $2,000 profit. Now, I like the colors on the chart because you can see with the 10% out of the money ones, almost the whole entire chart is green. The only way that you can lose money on this is if we stay under 400 a share. And if you're even remotely bullish on strategy in 2025, outside of some kind of black swan, like expiring in July. And just keep in mind when I mark my cells, my values, I'm using the 20th. Whatever's close to the 20th, I'm using this column here for March, April, May, June, and then we expire on July 20th. So 10% out of the money, all you have to do is hit your break even of current price was like 330 plus the 6 grand. So you got to get to like 390, right? As long as you get to 390, you're green. You're making money here. I don't say it's impossible to lose money with the 10% out of the money strike because anything's possible. Like we we could be under $400 a share. And the other thing too is like, what are you going to do with it? Because even if we only get to 400 a share, the 10% out of the money option is profitable all the way through May. You can still kind of like break even through May, which kind of makes sense because each contract is worth more and theta is less at the money. Theta is going to be way higher at the 1080 strikes that I'm buying. So there's trade-offs for this. So let's just keep going here. If we are at $880 a share in March, the 360s will get you 46 grand. And it's, so deep in the money at that point, you don't even really lose much if you hold the 880s to expiration. And all of that, it just that same theme continues with the 10% out of the money ones. And here's the well, I'll get to that part later because my assumption is that if you're buying them 10% out of the money and then you're attempting to capture this part of the curve, you're not going to hold a 400 or a 500 strike to $1,980. It's just so deep in the money that it's acting like a synthetic stock position. All the way at, almost 2,000 a share, you're making shitloads of money, of course. And then there's almost no theta decay here. You can hold this all the way to expiration and you're only going to lose like $1,000. The other advantage is that once it does go in the money, once we do get to 440, actually closer to like 500, 550, 600, you can start selling covered calls against these positions. So the 10% out of the money that goes 10% in the money that they're talking about can be converted to serve another purpose as well. But if you'll bear with me, let's go ahead and fill out this chart with the right frickin' numbers now instead of me screwing it up. All right, so March 21st, the 440 is 4260. So if we get a nice pump by March, the 1080s will make a little bit of profit, but less profit than the 10% out of the money. April 20th, 440. The 1080s are already losing money. So if we don't get rapid price appreciation on these 1080s, I'm already kind of taking it in the shorts down here. What did I say that was? Minus 980? Minus 970. Yeah. negative 970. So the 1080s that I like are already losing. They're getting their ass kicked. So May, it's even worse. Negative 4480. And I probably don't even need to continue this because this is just, it just keeps even getting worse. June and expiration is just catastrophic. And then at expiration, if we're at 440, you basically lose the entire position. All right, let's look at the 880s. 880 for March 21st is 132, 310. 132, 310. This is starting to look a lot better. So this is where the 1080s really shine. Like if we get just insane rallies, then the 1080s can start to outperform. Let me just hit another couple of points. So April 880 is going to be 104, 380. Oh my God. All right, now you can see that if you're at 880 in March with the 1080s, you made a shitload of money. But if you hold for another month and we're still at 880, you've just lost $30,000. Whereas if you win big on the 360s and you hold, you're only losing like $200 because this is just so far deep in the money at this point that theta decay is kind of meaningless. But let's continue this trend. I got to do May and June and expiration here. May 80, 880s turns into 72010. And you can see this trend. Oh my God. That is annoying as shit. All right. I'm going to skip June and we'll just go to expiration in the interest of time. Look at that. You can actually turn an insane winner with the 1080s, right? Actually, maybe I will do June as well. So the June 880s, you're still clinging on to some profit. So 32,660, but then we get max loss at expiration. Damn it, I already forgot what it was. 32,660. And then max loss. So I think the answer to this question is the same as it always is that there's always a trade-off. And then the point that I was going to make as well is that what are you going to do? Are you going to do you have the skill to use a little bit of skill when strategy gets to 440 with this out of the money strike? And then are you going to close those positions and then buy, are you going to have the balls to buy the ones that are 10% out of the money again? And now you're going to buy the 480 or the 500 calls. And when it gets to 550, Are you going to buy the $600 calls? Because you can only do that for so long until we hit resistance, and now you're FOMOing in at the top, right? When the price was 229, if you're buying the 250s, you can roll up to 300, you can roll up to 350, you can roll up to 450, and then when we got here to 473, if you're still rolling these up, now you're gonna be down even more than where you started if you're rolling the 450s up to 500. So are you going to be skilled or lucky enough to know that, okay, I'll roll to 3, I'll roll to 350, I'll roll to 4, but I won't roll to 5? Are you going to be smart enough to just exit to cash or to shares here? You might, if you're following the implied volatility chart, you might hit this somewhere in here. Implied vol really started to collapse after November 27th, which would be right here. So you're not even going to, if you're watching the implied vol spike, you might not catch it right at the top. So you're going to have to stop rolling up. Let's see if you got 250. You can roll to 3, you can roll to 350, but you really probably shouldn't be rolling to 4. Whereas with the 1080s, it's a different mentality for me because I'm never really expecting to go in the money. It's so far deep out of the money that I'm not holding my breath that we're going to see 1100 or 1200 or 1300 or 1500. I'm probably let's see, if I'm spending 6 grand, I can 10x my money when we get to, I can 10x my money in April at 770. Is it very am I gonna, if I have 20 of these, am I gonna seriously just sit here and take no profits if we hit 770 in April? Hell no. I'm taking at least half of these off the table. If I sell half of these positions at a 10x, even if the other half, do go down here and are completely worthless, I still got a 10x. I probably end up with like an 8 or a 9x. And then the other half, I can either just hold forever or I can sell another half when they get to 20x somewhere. What's that, like right here? So if we hit $1,000 a share by May, okay, maybe I sell another half of my stack. So I think the answer is what the answer always is that every single option, every single strike, every single expiration has a trade-off. I win if we're talking about how do I just, possibly get astronomical profits for the least amount of money if the amazing happens. That's when the deep out of the money strikes are at their best. They are at their worst when we're just like kind of around our break even, and then, you know, you get a good win, but you don't have you're FOMOing, so you don't have the balls to take profits here. and then you just hold on to this thinking it's going to 1,000 a share and it doesn't, and you lose all your fucking money. The 1080s, I mean, it makes sense. The 1080s are the riskiest possible strike you can select. It's at the top of the chain. It's it's cheap as shit for a reason because the delta on it is so small. The market makers are basically saying this is a lottery ticket. It should be extremely risky and it should be extremely rewarding if it hits. But are you willing to take that risk? When I'm just speculating, this is what I like to go for. However, if you want to capture, let me just go back to their graph again. If you want to go for a different strategy and you want to capture this maximal, you know, gamma curve, you can just do this one time and you can take this position off when it's 10% out of the money and you can book your profit, you can double up. And it's kind of hilarious that Bitcoiners and strategy holders almost kind of like scoff at doubling your money in a month or two. That's kind of insane. Like these are insane returns here. I mean, even turning 6 grand into 156 grand is insane. 10, 20, is that 20x, 25x, something like that? But there are diminishing returns, right? If you win this by the end of February, it just stays 156,000 all the way to July. So what are we talking about? You might as well just exit this position and take the cash now because you're risking 5 months for no real price appreciation. I mean, the price could go to 2,500 or 5,000 a share, I suppose. But if it goes to 1980 and stays there, this position is not moving. But you're running the risk of it dropping back down to 400 and losing your money. So, I have not like independently verified, whether that graph is accurate, but I mean, it makes complete sense to me. This makes absolute sense, right? Something's just out of the money. Once it goes at the money, that's when uh, delta is getting maximally accelerated by gamma. And then once it goes in the money, there's got to be diminishing returns because delta can only get to one. It can never go above one. So the closer it gets to one, the harder it's going to be for gamma to pack a little bit of extra value in there. And when it gets to one, gamma is effectively zero because it cannot increase delta beyond basically a synthetic stock. It kind of reminds me a little bit of the way that Elon Musk described battery charging because even when you're taking a long trip, supposedly they recommend only charging the battery to like 80 or 90% because you can charge it to 80% in like 15 minutes. And then if you want to get the last 10, 20% in there, because the electrons are, the battery's just packed full of charge and it's hard to get it up to 100%, it takes like another half an hour just to pack that 10, 20% in there. So you can actually get to your destination faster if you stop more frequently, but spend half the time charging. And that's kind of the way that I look at delta. Like when a battery is 80% charged, it's kind of like delta being at a point 0.8. It's getting so close to 1 that it's hard for, up in here, it's hard for gamma to pack a few more electrons into that delta. And as it gets close to 1, it's just, it doesn't matter if strategy is going from 2,000 a share to 5,000 or 50,000 a share, something ridiculous. There's just no more delta being packed into that battery. Um, so do you have the skill to exit, or the discipline to exit your position when it's 10% out of the money? And then do you roll it and go 10% out of the money again? And do you keep tempting fate until you end up here and then you end up losing money? Um, I did that. I was FOMOing into the 1080s in November and lost a bunch of money on that. I think I only took like 10% of my leverage off the table here. And that's kind of another good point because I know some of the commenters are like, oh, yeah, some of you guys are losing money because you didn't cash out here. Well, if your time horizon is till the end of 2025, then you're grading the trade in the middle of the exam. So to say that some investors are better than others in November of 2024 is premature. Some of these trades have been in the works since, mid 2023 or maybe even before. What was it? Radu, he had that famous screenshot of when he was buying, crazy out of the money positions for January 2025, but he was buying those back in 2023, probably at least the beginning of 2024. I don't remember the specifics. But some of these trades have been going on for months and years. And the test is still in progress. At the end of 2025, if you can say that a certain person has underperformed, then that will be fair. But um, peak November, I think I had like 8 or 9x my portfolio, and it's probably down 60, 70% since November, but it's still up like 4x from March. So, um, am I being graded from March or am I being graded as a failure since November? Everyone can make up their minds on that. So, long story short, I love this graph. I love the way that some of the stuff makes me think. And every every option could be the perfect option depending on your goals. And I had an episode about that too. Like, should you sell covered calls? Okay, do those calls, does selling covered calls meet your goals? Does buying 10% out of the money and capturing this curve meet your goals? Do you have the skill to manage those positions? Do you have uh the skill to, or I don't know if it's mental fortitude, to hold on to a 1080 and exit those positions, and be okay with, like, damn it, where is it? Exiting a 1080 position, can you hit a sweet spot and exit it in green and not hold it too long and end up with a loss? Each option has a certain, I guess, optimal trading, mechanics to go along with it. So it's not just like, okay, is this one better or worse than the other one? It's, is it better for the goal that you're trying to set within the skill set that you have and the mechanics that you're able to take advantage of? And then let's just sprinkle some luck on there too. Monitoring implied vol, all of these things factor into the decision. And I think to a certain extent, the argument about, because everybody just wants to know what strike, what about these strikes, what about this expiration, what should I do with this, what should I do with that, and to a certain extent, none of that matters as long as the basic assumption that the 4-year cycle will continue through 2025 for Bitcoin. If we get a Bitcoin pump, then strategy benefits, and all of the shareholders and all of the long option holders will profit, as long as you don't do something stupid, which I had an entire episode of that. So as long as you don't have too much money traded on margin, so that, if you're margin to the gills, up at 500 a share, you might not survive the collapse to 289. As long as you're not FOMOing in here and buying leverage at high IV and then panic selling here, you're probably okay. Even if you are FOMOing in here with 1080s and losing a shitload of money, like I did on some of my positions, as long as your time horizon is 6 months, 9 months, 12 months, you still might be okay. So you can even make some of these horrible mistakes, but if you give yourself time to be right, you may be able to claw your way back. But if you're FOMOing in November for December options, you are getting bent over. That's just how it is. You could get lucky. I mean, we could have went to 1,000 a share. Like, I would have loved to have been at 1,000 a share in December, but even though I don't do technical analysis, like, support and resistance are real things. We hit resistance at 500 a share. We found support at 289. There's not a whole lot to argue about there. We could have hit resistance at 1,000. We could have hit resistance at 350 and collapsed to 175, if we had a 50% drawdown. So really, I don't think the all important question is, should I buy 10% out of the money or should I get the deep out of the money 1080s like I prefer? It's more like, can I avoid the mistakes that will cost me to lose my ass? I'm bullish on any bullish strategy for strategy over the next, what we got, another 10 to 12, yeah, 8 months gets us to October. The next 8 to 10 months, I'm bullish on the Bitcoin cycle. Some people are more bullish about an extended bull market, or maybe the 4-year cycles are over and this is just super cycle and its number go up forever. Um, I'm not that optimistic, but I also don't need to be that optimistic. Like, as long as we don't get absolute catastrophe, um, I should be fine, having quit my job in December. So at some point, I just don't really need to take much more risk. And it's just about doing whatever the hell I want to do every day. So I hope that explains my position and why I like the deep out of the monies, but why I also respect the graph and the strategy. So it's not about like better or not. It's just kind of like, what's your goal and what does your skill level allow you to execute, and sprinkle some luck on top. All right. Oh, Jesus Christ. Oh, I got scared for a second there. Somebody says we can't hear anything, and then other people say they can hear fine. Okay. I did talk for, like, half an hour one time with no volume, so that does terrify me when I see those comments. Um, 94 says, "The way Bitcoin is looking right now, there has to be a crazy pop towards the upside." Yeah, I'm kinda feeling the same way, and, I mean, I'm not saying that strategy can pump the market all by the little own lonesome, but their purchases are not, like, just trivial. And if they get the convertible bond offerings going, that's just going to be more buying buying pressure on top of buying pressure. So yeah, it does feel like the spring is being compressed, and something's got to give. Um, yeah, we really didn't get much of a pump between March and November, so I hope it doesn't take 8 months from November to get another pump. Um, I'd like to see at least two in 2025, but I'm putting all my eggs in the basket of we get at least one. We get at least one nice rally in 2025, and if and when we do get it, I'll probably take at least 50 to 75% of my leverage off the table. Um, I might just take it all off the table, and if we get a second rally in 2025, I'm still gonna benefit. I'm just not gonna get a leveraged benefit, right? I don't have to have long calls on all 24/7, like, all YOLO all the time. It's okay to just hold shares when the number goes up. So, we'll see how that goes. But the other thing that I'll be doing is converting my leveraged strategy positions into Tesla positions. Dude face, yes, you must tempt fate. Leverages for income. That's why we do options. I've brought in 6K in the last 2 months just on weeklies in 100 share position. Holy shit, that's nice. I am starting. I'm gonna do some check my trades and see if I need to actually make any trades. But I have been kind of like trying to put on as few covered calls as I can possibly get away with. So with this account, I under basically every trading environment, I carry a covered call against leaps. I don't care if IV is high or low, really, because implied volatility, while it's not giving me the highest covered call premium, right? I'm getting paid less, but it's also cost less to buy and hold the leaps. So I'm not just comparing my premium collected versus the price of a share, it's versus the price of another option. And so it just makes it a little bit more agnostic about what the actual implied vol is, because if I buy a leaps for cheap because implied vol is low, I'm also going to collect less money on the covered call, and those kind of balance each other out. But if I buy a leap at high IV and overpay for it, I'm also getting overpaid on the covered calls that I sell against them. So I don't mind having 6 covered call positions on all of these leaps. That all makes sense. And the other thing too, with an option seller's account, you want to have a net positive theta, which is this column here. And every time I buy a long call, I'm adding drag to the account. So I'm losing $10 a day for this option. I'm losing $43 a day for these 3 options. I'm losing $24 a day for these options. And so in order to, for my account to just not be decaying every day, these covered calls pay for that. I'm kind of like renting these leaps. Instead of owning the shares, I'm leasing the leaps. I'm leapsing, maybe. And then these, it's not that I'm like, okay, I don't think that strategy is going to go over 345 by next week. I really don't have the slightest idea. However, I did have bills to pay and I had to take out like 5 grand. So I needed to, um, had to sell some covered calls. Or the only other way for me to get money is to just sell shares. So I took a chance, and while I don't think that selling at the money covered calls in low IV is optimal, again, it's does this meet your goal? And for me, making sure that the mortgage is paid and I am not evicted meets my goal. So the only way for me to get money is either to sell something that I own or potentially sell something I own and agree to sell a covered call at a strike. Now, I could have went out to 45 days to expiration, gotten about the same amount of premium, but I really, I'd have to wait 2 or 3 weeks to buy this one back. Whereas in this case, I only had to wait 4 days and I can close these positions for and keep like 75%. Turn down the volume. All right. Now I'm using $1,200 in margin, which I don't like. I'm also carrying a negative theta again, which I'm probably going to have to just deal with because I want to keep as few covered call positions on here as possible. I just want to have enough positions on, to kind of keep the lights on. And so let's just see if I roll down my strikes to near at the money again. I can put on 2 more covered calls. So I took off 7 and I'm adding 2. Did it fail? Okay, looks like it failed. So I don't like that I'm carrying negative theta here. This is bad news for an option seller's account. But let's look and see. So I may go ahead and add a little bit more leverage here. If I sell 100 shares, it gives me 32 grand to play with. And let's look and see what kind of leaps I have. I probably could probably get away with the 300s. I can get a couple more 300s. Almost 0.7 delta. Sorry. And how much do they cost? They're gonna cost me 139. So two of them is gonna be 28 grand. That gives me a little bit left over. Now, you know what? I'll buy the two. If I get the 250s in January, that's gonna cost me 13 each. Yeah, let's do that. Now this added even more drag on the account. My my net theta is even lower. However, if I go out to 45 days to expiration, and what did I pay for these? I'm sorry. When I'm forming a poor man's covered call, I got the 250s and they cost 132. So that means if I add those two values together, if I get myself a right or at least like the 380 strikes, those are all safe trades. But one of the things that I like to target is at least, approximately 1% a week. And so 1% of the current price would be $3. So if I manage this every 2 weeks for half, that means I need to multiply that 1% times 4. So that gets me to 1,300. So as long as I collect $1,300 of premium, which would be at the 400 strike, and if I buy this back for half price in 2 weeks, then that means I get to keep about 350 bucks, which is 1% a week. So I'm going to do two of these, and let's just see what this does to my theta. Okay, it knocked it down a little bit. And that gives me another 8 grand to play with. So I'm going to sell another 100 shares. And now I think I can pick up 3 of those positions. Two 50s, right? Yeah. So I'm basically selling 200 shares and picking up 5 leaps. Now I can sell 3 more covered calls in March. And let's do the 400 strikes again. Yeah. So that chipped away at this negative theta here. And let's do if I do one more 400 and cover one more of my 100 shares, that's going to just get me just on the positive side of positive theta. I thought it would. Doesn't that say that's positive 200? Oh, because it's split, it's split up against, it's divided up between 6 accounts. That was unfortunate. All right. I think I'm inclined to leave it there. If we do see 300 a share, or if we see 275 or even 250 a share, I want to have room to be able to add even more leverage with these shares. So I'm going to have to swallow my pride as an option seller and just let this be a little bit of a drag on the account's value for now. It's hard to stomach as an option seller, but while implied vol is so low, I'm just kind of waiting for that coil to spring. All right, MSTY is kicking my ass. They're down like 20 grand on I think I started out with like 215,000 or something. So they're down like 20 grand, and I think my account is down like 40 grand. So let me just take a look at that one real quick. I think I'm going to do a similar process here and sell. Oh, you know what? I didn't spend all my cash, did I? Do you know what? I think once I pay my credit card bill, I'm probably going to need this cash. So I'm just going to leave this here and give me a little bit of flexibility to make a withdrawal. All right, so here I'm going to sell 100 shares. It's 12 grand a pop. But why do I have 32 in cash? What did I just do? Yep, I sold 100 shares. Yeah, that should give me 32 grand. Oh, I think I was looking at my margin buying power. All right. 32 grand. I can actually get 3 of the 300s. So January 300s. And I'll just dollar cost average into these. Now I'm using a tiny, tiny little bit of margin, but I won't be as soon as I add the covered call positions. So I've got, I'm just going to say that this covered call is actually not against shares. I'm going to say it's against one of these positions. So that means I can add 2 more covered call positions. And where did I say? 400 strike gets me about 1,300 bucks. So 2. The other thing is I can close this one and keep the 800 or 900 bucks profit. And I think that's gonna let me add one more. I can add one more covered call if I so choose. So I got 9 leaps, and I've got 9 covered calls against them. See, I've got a negative theta in this account, and since I'm supposed to be competing against MSTY, I should probably carry a positive theta. So let's sell one at the money. Covered call. Let's see, the price is 320, so let's sell a 350 or 330, excuse me. Yeah, I got positive theta. I've got all of my leaps covered, and I've got one of my 200 shares covered. And same thing here. If we hit 300, I'll probably peel off another 100 shares and add leverage. If we see 250, 275, I'll peel off the last 100 shares. And if we go down from there, I'm just even more screwed. All right, that gives me 2,000 in cash. So I might as well dollar cost average into these July 1080s. Can I get 4 of them? This might screw up my theta ratio now. Let's see how much theta decay this adds back in. Okay, I'm still positive. Whew. Wipe a little sweat off my brow there. No cash to speak of. I like where this is going. Um, Begrudgingly, I have to admit that MSTY is winning, and it's probably going to get worse before it gets better because ex dividend date should be coming up soon. So they are actually going to get this account will actually get some Misty dividend paid out, and then I will immediately purchase more shares. So whatever Misty's up now in a week or two, they're probably going to be up any another 10% against me. And if we don't see a rally until March, April, May, I could be in a world of hurt for quite some time before it could get much worse before it gets better. That's the point. All right, the joint account, I've just like limping in with some negative theta here. And I really can't add any more positions. And this isn't quite under 50% of what the trade price is. So I'm just going to hold on to the March 21st for another week or two. Nothing really to do in this account but wait. My allowance, I got 200 bucks. I got one poor man's covered call. Can't really manage this yet until it's under probably 500 bucks. So nothing to do here. The 5K account got some stuff expiring on the 14th. This buying power is fake. I only have 189. So I got 1389 minus the $12, 1200 in options collateral. My poor man's covered call expires on the 21st, so probably nothing to do here. Same thing. I have 2 of them actually. So this one is the 21st, and I won't be buying this back until it's probably 450 or less. So nothing to do here until Friday. Let's check the chats and then call it a day. What's up, Niz? This says, what are your thoughts on synthetic longs, and have or would you ever do them? If the synthetic longs, you mean like I just do poor man's covered calls, which isn't 100% synthetic. You have to be kind of careful with those. Um, I'm assuming you mean the synthetics that like MSTY uses, which would be something like buying a call. Let's just remember this is 0.64 delta, and then selling a put, same strike, same expiration date, 0.36 delta. So the 0.64 delta added up to the 0.36 delta yields, 1 delta, which is 100 shares. So if you buy a call and sell a put, you end up with a synthetic stock, and this is kind of meaningless to me. I don't understand. Well, I think MSTY can't just hold 100. I think ETFs have rules. They just can't hold all the shares and just sell straight up covered calls. So I think they're forced to do these things. So what would this actually cost me? This would cost me $1,100. So that seems like, oh, cool. I can control 100 shares of MSTR with 1,100 bucks, right? That sounds like a great deal. However, when you sell a cash secured put, you have to put up the 32 grand. So you're already putting up the 32 grand that it would cost you to just buy the 100 shares. So this is kind of a wash. This doesn't make any sense. For me personally, if I want shares, I'll just buy shares. Um, Depending on the margin rules, I suppose there could be an advantage to this, but I don't know what it would be. So no, I don't do this. I don't really see what the advantage to doing this would be. But if somebody wants to explain it to me, it might make sense. Forrester says win 450. Adapts like a tadpole sprouting legs. Yeah, I'd like to sprout some extra legs. I need 450 so bad. It's not even funny. Nis says I might have missed it, but did you roll down your strikes as Josh did? Not all of them. I only had 7 at the money covered calls on last week. I closed all 7, and then I think I opened up 3 new ones. Let me just double check. So I had 7, and I closed those and added 2 more just to cover the cost of closing them. And then I could have left it there, but I made a bunch of other trades too. Added some poor man's covered calls positions. So I've got some rearranging to do. I'll worry about all these groupings after the call. Niz says, not sure if you're familiar with Invest Answers. He always does the synthetic with margin. Okay. Yeah. To me, it just works out to about the same. Like if I have to put up 32 grand for the synthetic long, because on margin, if I just buy 100 shares on margin, they're only going to reduce my buying power by 50%. I can't imagine you're going to get much better margin rates for a synthetic long than you will. Every trading platform is probably going to be different too. Like you might only get 20% reduced buying power. So buying shares, you might have to put up $23,000 worth or something. So there could be favorable conditions on the options, I suppose. But let me just see if I sell and I'm at the money put the 320 strike. That's going to reduce my buying power by 16.7. So the difference between 16.7 and 7 17,000 is literally just this little $700 credit I'm getting paid for the cash secured put. So I don't see any advantage. All right, we are all caught up. Thanks everybody for joining in.